Good morning, everyone. Welcome. My name is Breda Griffin. I'm a director in the Prudential Regulation and Risk Management team at Mazars. So today's webinar will be a discussion on what we know so far about the PRA's implementation plan for Basel 3.1. With insight from the PRA CP 1622 in November 22 and the first set of near final rules in PS 1723, we will also give you an insight of the discussions we have been having with clients over the last year and a half, as well as Mazars' research on how change will impact banks' capital requirements. So Basel 3.1 is intended to be the final set of amendments to the capital regime for banks following the 2007 and 8 global financial crisis. So let's start with you, Freddie, for credit risk. From your discussions with the industry, what proposals for the credit risk standardized approach have garnered the most attention?
Yeah, thanks, Breda. So basically, we've been in discussions with the market for well over a year now. I think I'll just start with the three focus areas for firms that are always coming up in conversation, following in particular publication of that consultation paper, which seems like a long time ago now, back in November 2022. And those three areas: removal of the SME support factor, increase in due diligence expectations, especially around unrated exposures, and the introduction of new mortgage exposure classes and the impact this will have on capital requirements. So if I just go through those three in turn, starting with the removal of the SME support factor, essentially, as many in the call are aware, the SME support factor was really meant to be a temporary measure and was introduced during the financial crisis. The thing to remember here is that for all the airtime that the proposed removal of the SME support factor has been getting, fundamentally, the PRA consultation proposals align with the BCBS. And so what the PRA is proposing is basically a new treatment for unrated corporate SME exposures that are getting an 85% risk weight, which is 15% less than for general unrated corporate exposures. And they're also proposing basically a sliding scale for retail SME exposures with risk weights varying from around 50 to 120%, depending on a number of different factors. I know there's been a lot of discussion out there and a lot of analysis. We've done our own research into the impact that removal of the SME support factor will have. Our analysis suggests, and what we looked at was that if you're a smaller bank with material exposures to SMEs, you may see an increase in your RWAs of about 3 to 5% overall. And the dummy bank balance sheet that we use for this analysis blended together kind of several small to medium-sized UK lenders with significant UK exposure, significant SME exposure to try and make that representative. But as I've mentioned, this has become a bit of a political hot potato. The PRA also, as part of the proposals, has a desire to maintain international competitiveness. So there's a strong possibility that when the near final rules come out, the consultation proposals may be amended. And it's certainly one of the first things that we're going to be looking for when the policy statement emerges from the PRA. Moving on to the due diligence expectations. So overarching the standardized approach proposals, I think it's fair to say PRA's desire is to reduce reliance on external ratings and attempt to place more of the onus on firms' counterparty due diligence and firms' own understanding of risks. So we can see this, for example, in the proposed treatment of unrated corporates. So what you've got there is firms are able to choose between basically a risk neutral approach or a risk sensitive approach. And under the risk-sensitive approach, there is the opportunity for counterparties that are considered investment grade to have a 65% risk weight, which is significantly lower than the risk-neutral approach. Of course, there are expectations that, if firms are able to use this risk-sensitive approach, they'll need to demonstrate to the regulator that they've got sound and comprehensive due diligence processes in place to accurately assess risk. Firms will also need to pick one external credit rating agency for all types of exposures and risk for risk management and risk weighting purposes. And essentially what this does is it's also reducing the flexibility for firms to cherry pick, which is the PRA's words and not mine, the sort of best credit ratings for individual exposure classes. And then the third and final area subtopic that I wanted to raise was around the introduction of new exposure classes around real estate exposures. So what you've got there, first of all, is a couple of different key elements to these proposals. One is around sort of valuation approaches, where the PRA is at the moment proposing that the value of the property should be the value at origination. So it considers this to be the valuation obtained by the firm when it issues a new mortgage loan to an existing or new borrower. But I think that operationally, this might have some real implications. So at the moment, for example, the draft PRA rules are pretty ambiguous on what types of valuation will be permitted under the new approach. So, for example, most firms follow 4 different types of valuation. On the more simplistic side, you've got physical valuations, desktop assessments. On the more sophisticated side, you've got things like automated valuation models and HPI indexation. Sometimes, of course, firms use a combination of these approaches. Further clarity in the near final rules on this, what PRA's preference is in terms of the blended approach to valuation by firms, is definitely something that we'll be looking out for when the policy statement is published. And then, of course, there's also a big change in terms of the definition of real estate exposures. You've got buy-to-lets, care homes, purpose-built student accommodation, all now falling under classes defined as being materially dependent on cash flows generated by the property. And as we'll get onto shortly, that's going to have pretty material capital impacts, we believe.
And I think one thing that firms would be keen to know is ultimately, what do these credit risk changes mean in terms of capital requirements? So they're likely to go up or down, in your opinion?
So at the moment, under the current proposal, they're probably going to be winners and losers. So if I was going to, give an example of what a loser might be in terms of, firms have significant exposures to this type of lending, then they might see a material increase in their capital requirement. That's going to be those sort of buy-to-let, multiple occupation, care homes, student accommodation type exposures that I've already mentioned. Basically, anything that's considered now materially dependent on cash flows generated by the property. They're seeing material risk weight increases. Now, for example, if you take the proposal for holiday lets at the moment, that's that they should be risk weighted in line directly with commercial property at 100%. So a significant increase on what we're seeing currently. But on the other hand, there are some categories that will see, we think, a general decrease in capital requirements according to the proposals. So, the big one would be around prime residential mortgages. One of the main aims of the standardized approach proposals is around increasing risk granularity. So as the risk granularity for real estate exposures is increasing, low risk prime mortgages are likely going to benefit from reduced risk weights. And then the other area that I've already mentioned again, which links back to that increased focus on a bit more of a granularity in the standardized approach, is for unrated corporates. As I mentioned, under the risk sensitive approach, if firms are able to opt for that, unrated corporate exposures will fall from 100% risk weight to 65% risk weight in the event that they're investment grade. So that's, again, a significant improvement.
And very quickly, just on internal models, so what do you think the PRA is looking to achieve here?
So the main thing to think about when it comes to internal models is, and it's aligned with the fundamental intentions of the Basel proposals, is the PRA is primarily looking to restrict elements of IRB internal ratings-based models, increase their conservatism, and bring closer alignment between the IRB and standardized approach. So as part of this, the regulators are hoping that the IRB proposals, they're going to reduce excessive complexity and also what is currently perceived as being a lack of comparability in IRB firms' calculations of their RWAs. So on the flip side to that, the PRA also now believes that following the Basel reforms, as a consequence, the IRB approach may be a bit more prudent. And so therefore, what they're looking to do is change the threshold for IRB model approval from full to material compliance. And so what that actually means is that the PRA's definition of material compliance is that any non-compliance results in a minimal impact on qualitative and quantitative aspects of the IRB models or model. And what this could result in is actually a speeding up in the model's approval process, and may also improve the ability of some of the mid-tier firms to achieve IRB model approval. So whilst the PRA on the one hand is increasing potentially the conservatism of some of the model approaches and therefore reducing the capital benefits, they're also on the other hand potentially under the current proposals going to increase the ability of firms to actually achieve models approval. My also view is that these current proposals around materiality and increasing the ability of firms to achieve credit models approval is also an implicit acknowledgement of the fact that the current situation, where firms are often spending millions and waiting years for a decision by the PRA on IRB model approval, is just not sustainable.
Thank you, Freddie. And while we're speaking of the objectives of the PRA, we know that they are intent on reducing variability across IM firms, which actually brings us nicely into another well-awaited change, the introduction of the output floor. So Hussein, could you provide us with a recap of what the output floor is, what it's looking to achieve in the transition period involved?
Thank you, Buda. Yes, the output floor has received a lot of attention from the industry. So for firms using internal models, they will also need to calculate their risk-weighted assets using the standardized approach for the relevant risks. And the risk-weighted assets at aggregate level cannot be lower than 72.5% ultimately of the standardized approach calculation. Now, this will be phased in from 3 to 4.5 year period. So it will start at 50% and it will increase to 72.5% by 2030.
And who will the output floor be applied to? Also, are there going to be any differences between UK and overseas firms?
Yeah, so this is quite interesting. The output floor will be applied for UK headquartered firms at the consolidated level, and for ring-fence groups, it will be applied at the sub-ring-fence group level. However, for international headquartered firms, so subsidiaries of foreign banks, it won't be applied locally by the PRA. The PRA will be monitoring, I believe, over time, how other jurisdictions apply the output floor, but there is a bit of concern by domestic banks around the level playing field with international firms in this space.
And what do you think the challenges are that the industry is seeing?
So I think apart from the international versus domestic, building societies and those who have monoline businesses focused on mortgages are concerned about the disproportionate impact this will have compared to those with a more kind of diversified portfolio of maybe more risky exposures as well. In addition to that, clearly firms invest a lot of money to maintain their models. So as the benefits of having models reduces, we'll have to see over time what does that do to firms actually taking up the option of having models for their RWAs.
Okay, thank you. And just a polite reminder, if people do want to put questions in the chat, please feel free. So now we'll move on to operational risk, which I think is more controversial than people realise. Hussein, the firms seem to welcome these proposals. What are your thoughts?
Yes, there seems to be less pushback on these changes. Clearly, we've currently got about 4 different approaches to calculating operational risk under Pillar 1. This will all be streamlined under the single standardized approach. It will have 2 key components, a business indicator component linked to firms' P&L, and larger firms will have larger coefficients, and therefore they'll have to hold more capital under Pillar 1, and an internal loss multiplier, which is linked to historic 10-year data of operational losses. Now, the PRA set that to 1, therefore breaking that mechanical link. But firms in general seem to welcome the simplicity, I think, of this approach. But there, again, a bit like Freddie mentioned earlier, there will be some potentially winners and losers of having that ILM set to 1.
Thank you very much. And now if we take a look at market risk, so I think we are seeing similar themes to the credit risk proposed reforms. Nicholas, could you provide further details on this, please?
Yes, thanks, Breda. So the PRA will implement the Basel 3.1 market risk framework with essentially no material change between the consultancy and the policy. And that despite some industry concerns that the Basel text in some aspects might be too restrictive or punitive. So one important note is that there will be restrictions on how firms assign positions between trading book and subject to market risk framework, and non-trading book and subject to credit risk framework. And in addition to that, there will be limits on how firms can put internal hedges to transfer risk between market credit and the CVA risk framework. So just to recap, there are 3 methodologies available to firms: simplify a standardized approach for firms with very low market risk positions, advanced standardized approach, and an internal model approach. And the Basel text is thought to be, for some firms, so complex that at this point in time, only 2 firms in the UK are rumored to have applied for an internal model approach, and 3 firms in Europe have applied for the IMA option with their supervisor at this point in time.
And then lastly, before we move to the Q&A, if we talk about counterparty credit risk, so the credit valuation adjustment front, what do you see as the key changes in this regulation?
So broadly, the PRA has implemented the Basel standards with few changes on that respect as well. A few things that are worth noting. First of all, on the CVA framework, the PRA removed from the existing exemptions from the CVA capital requirements transactions with non-financial counterparties and pension funds. They have introduced a new risk weight for pension funds lower than the Basel III standards to offset that, and enlarge the definition of pension scheme agreement to include third country pension scheme agreements. The PRA has retained from the CV exemptions anything that is client clear, the intragroup transactions. To partly offset the increase on capital that is expected from that change, the PRA has, in line with the US agencies, lowered the SSCCR alpha parameter from 1.4 to 1 for NFC, non-financial counterparties. And it's also worth noting that this is a different approach to the ECB that has maintained an alpha parameter at 1.4 across all counterparties, but has retained an exemptions from NFC from CVA capital framework. So the CVA capital framework will essentially comprise of 3 approaches: the alternative approach, the basic approach, and the standardized approach. The alternative approach essentially consists in not calculating any additional metric, but instead simply doubling the firm SSCCR, the counterparty credit risk requirements, and that is only available for banks with a notional of unclear derivative lower than 88 billion. Pre-notification to the PRA is required for that. The basic approach, BA-CVA, essentially relies on SSCCR or potentially IMM exposure at default, and it allows recognition of certain credit hedges, but anything that any market risk hedges that the firm would put on would need to be capitalized through the market risk framework. And finally, firms can apply for the standardized approach, SSCVA, which is more closely aligned to front office and risk management CVA, and offer an appealing alternative for more advanced banks. However, that approach requires supervisory approval. From a technical challenge, this standardized approach requires calculation of complex CVA sensitivities with respect to CCR, but also with respect to market risk factors. We know at this point in time that over 10 banks are rumored to have applied for this approach.
Thank you. Thank you very much, Nicolas. We'll just go to Freddie, who will discuss the PRA's change in focus.
Yeah, I just wanted to quickly flag something that I've noticed in the past couple of weeks and recent months as well from conversations with people who are working at the Bank of England, that obviously you've got 2 competing objectives at work when it comes to these proposals. One is around the fact that the PRA wants to maintain its position as being seen as a leading international regulator and therefore maintain compliance with the underlying BCBS proposals. That seemed to be the objective that was winning out at the initial stage of the engagement, consultation paper, etc., back in 2022. Now you've had a shift in language from the PRA. They're quite spooked by the fact that the US proposals, which gave them a bit of air cover because those themselves went quite hard and fast in terms of being quite penal from a capital perspective on firms. There's talks of a U-turn there. And they're now talking in the language of ensuring that they maintain international competitiveness. So as a consequence of that, I wouldn't be surprised if there were some actually reasonably significant changes on the credit risk side from what we saw in the consultation paper to what we'll see in the near final rules. So it's definitely not a fait accompli. And from conversations with people, you know, who work at the regulator, there might be some variance there. So it's definitely something to keep an eye out for, especially in some of the more kind of politically sensitive topics, things like the SME discount factor.
Brilliant. Thank you, Freddie. And, you know, always very good to get direct insight from what the regulators are thinking as well. So much appreciated. So we're now going to move over to the Q&A section of the webinar. So please feel free to put your questions in the chat box. We'll start with some of the questions that have already been provided to us. So the first question, and I'm going to go to you, Freddie. So implications for RWA on second charge mortgage loans. So there seems to be a number of ways of calculating RWA in draft rules. Can you elaborate?
Yeah, no problem. So I did some digging so that the team here, and to answer that specific question, basically in the underlying Basel proposals, the risk weight of a junior charge in a second charge mortgage loan is multiplied by 1.25 if the associated senior charges are not held by the firm. My understanding is that PRA is aligning with these proposals for both residential and commercial lending. This 1.25 multiplier falls away at the lower LTV rates, so basically below 50%. So right now, the one thing in the proposals in the consultation paper that I'll definitely be keeping an eye out for when the near final rules are produced is there's, for example, a limited detail in relation to the recognition of junior charges when there's an intermediate charge, for example, held by a different bank. So again, it's an example of where the PRA is given the sort of high-level answer in the consultation paper, but I think that there needs to be a bit more detail, and that's something that we'll be looking out for in the near final rules in terms of some of the sort of more niche applications of for example, second charge mortgages and other types of risk exposures.
Brilliant, thank you. And yep, please keep the questions coming through. So we've got one for operational risks. So Hussein, from your perspective, do you think it is wise not to include historical losses in the operational risk calculation?
As I said earlier, I think there will be some winners and losers here. Overall, it seems to make sense to me because it goes back 10 years of data to calculate your internal loss multiplier. Firms who've de-risked their business, maybe improved their control environment following events 7, 8 years ago would have been potentially penalized, I think, had they had to include that in their multiplier. But otherwise, for the firms who've had low levels of losses over the last 10 years, they may lose out on the benefits of not having a multiplier that's less than 1. I can see the reason from the PRA here around not wanting to mechanically link past losses going back 10 years, given businesses evolve, control environments evolve, and so on and so forth, and particularly the large conduct risk events that we've had in the UK. I think that would have impacted the calculation for a number of the larger firms as well.
Thank you. And
could I just quickly jump in just to add that the problem is that if the RLM is neutralized, there's no real risk sensitivity as far as I can tell in the proposals, correct me if I'm wrong, which means that would just continue to shift the sort of more risk sensitive applications of operational risk into Pillar 2. And as we all know, Pillar 2 is a bit of a black box. So, I mean, for firms, whilst it's obviously welcome in many respects that RLM is neutralized, it doesn't help in terms of really understanding how the regulator will go about calculating their idiosyncratic operational risk add-on. So I can appreciate that actually might be quite frustrating in some respects. There's almost, it continues to be quite an opaque approach from a capital perspective.
Yes,
Yeah, that's a good point, Freddie. And I think we'll have to see what the PRA does under the Pillar 2A methodology review as well on this. I think firms will be very interested to ensure there's no double counting through this approach as well.
Yes, agreed. And I think that the black box is definitely a good point, and it's something that we do hear from a lot of firms about what is the best approach they should be using for operational risk for their Pillar 2A. So in terms of Basel 3.1 internationally, we've got a question for Nicolas. I'll come to you. So what is the challenge that international banks are facing when it comes to implementation of Basel 3.1?
I mean, no jurisdiction has essentially implemented the Basel standard exactly as they were published. So if you look across US, Canada, UK, Europe, all jurisdictions have introduced some differences with respect to the Basel text, and that could be change in risk weight, exempting some specific trades, counterparties from a framework, market risk or CCR in particular, or change in parameters, as we discussed earlier. The alpha parameter for CCR is quite material. This obviously creates for international firms having to implement the standards in multiple jurisdictions, in operational and in infrastructure challenge. And it might as well create some regulatory incentive to do trades, more trades with specific counterparties in some jurisdiction rather than others whenever possible.
Agreed, and I think that we're seeing a lot more that international approach is prevalent for firms, and it's ever increasing. So the next question we've got is, what implications for the Basel framework will there be, given there is an increased regulatory focus on MBFIs?
Do we have enough time to answer that question, Breda?
In one sentence.
In one sentence, I suppose the answer is no. And I think that this is something that God help us all, but if there's a Basel 5, this is something there will be an increased focus on. So in particular in the counterparty credit risk, elements of the policy, I don't think there's too much granularity around MBFIs, firms' exposures, how firms should risk weight. So that's something to keep an eye out for. And I'm sure jurisdictions will be implementing idiosyncratic approaches across the board in the next sort of 2 to 3 years. So watch this space.
Excellent, thank you. So all the questions that we've been unable to answer today, we're going to follow up with a high-level response to all the attendees. Apologies, we've run out of time. This is such an important subject for everyone. We'll also have our feedback form, so we'd love to get your feedback from today's session and any other specifics that you'd like us to cover in future Basel 3.1 webinars. A few days after the PRA released their final policy, we're going to be holding our next session. So this is going to give an overview of the most significant elements of the final rules, and we're going to dig into what has actually changed since the consultation paper. But in the meantime, if there's any questions, please get in touch. We'd be happy to help. If you'd like to talk through specific circumstances, we'd also be happy to have an initial meeting to support you in your response to Basel 3.1. So thank you very much for joining us. Thank you to our panelists today for giving some great insight. As mentioned earlier, this is part of our Basel 3.1 series, so look out for future webinars where we will cover further topics. And lastly, before I let you go, we also have an upcoming webinar on solvent exit planning for non-systemic banks and building societies on the 20th of June. And that's it from our side. Thank you again, and enjoy the rest of your day.